Hello, Quint Bilo here to discuss the topic of adjusting journal entries. Journal entries that freshen up financial condition for various reasons. Reasons that may not be reviewed every day by accountants, but need to be prior to the preparation of financial statements. So, we'll be driving home the need to comply with accrual basis accounting versus cash basis accounting, which is all concerned about time. So the need for this topic is all concerned about timing issues, when we record transactions, for the purpose of obtaining financial statements that are fairly presented in terms of their financial condition. Accountants slice up the economic life of a business into time periods, artificial time periods. Why? Well, owners and other stakeholders don't want to wait a year or longer to determine what's happening, what are the financial results. So therefore, it's common that financial reports be pulled off on a quarterly basis or even monthly basis. We call this the periodicity assumption, which simply means financial reports are pulled off periodically. Now, the smaller the time period involved, the more work involved to prepare financial statements, simply because it becomes more difficult to measure certain things that need recording the smaller the time period. Time periods less than a year are termed interim periods. Public companies must prepare financial statements on a quarterly basis, not just annual. Fiscal years or any 12-month accounting period need not be a calendar year, but if it is, January 1st to December 31st comprises the company's fiscal year. So what does a time period assumption state? That the economic life of business can be divided into artificial time periods. Why all the fuss about time periods? Well, accountants need to be concerned with getting revenues and expenses in the appropriate time periods. If revenue was earned in January, we don't want to wait till March to record it. If we incurred an expense in February, it should be recorded in February and not in July. These concepts need to be matched each other to produce financial results which are fairly stated. Revenues matched against expenses required to generate those sales revenues. And this takes work, including doing adjusting journal entries. So we need to use accrual basis accounting techniques to get our results of operations stated fairly. By results of operations, I mean, do we make profit during a time period or was a loss incurred? We're talking about revenues versus expenses. So accrual based accounting is transactions being recorded in the periods in which the events occur and not necessarily when cash exchanges hands. Revenues, for instance, are recognized when earned, not when the cash may be later received according to the terms of sale. Likewise, expenses are recognized when incurred rather than when just paid. Incurred means the performance of the service has occurred and an obligation arises to pay it later. A lot of expenses are incurred on day one, and the supplier may allow 30 or 60 days before payment occurs. Two separate transactions. Again, expenses are recorded when incurred, not just when they're paid. This contrasts with cash-based accounting, which entirely relies upon the receipt of cash or payment of cash to occur before a revenue or expense transaction is recognized in the books, recorded in the books. Cash-based accounting, as noted, is not in accordance with generally accepted accounting principles. GAAP, as we recall, are the rules and procedures that accountants must comply with to pull off financial statements that are properly stated and not misleading. So let's look at the revenue recognition principle first. When do we record revenues? As indicated, when they're earned. In a service enterprise, for example, revenue is considered to be earned when the service is performed, when it's delivered. The diagram on the right indicates a sequence of events which leads up to a sale. First, a customer requests service. It's not been performed yet. The supplier of the service performs that service, and later, according to the terms of sale, they may receive cash, such as a 30 or 60-day time period. Credit sales are very common in our economy, meaning cash is not exchanged at the time the service is performed, but later. So the entitlement to receive that payment later arises, though, when service is performed. That's the point that revenues are booked or recognized in our accounts. Now turning to expense recognition principle. Expenses are matched with revenues in the period in which a company makes efforts to generate those revenues. As indicated, let the expenses follow the revenues. That is, expenses that are incurred or required to generate sales should be recognized or booked in that period, so the revenues and expenses are matched up in the same accounting period. For obvious reasons, accountants call this the matching principle. The diagram on the right illustrates this. Advertising expenses or utility expenses are commonly incurred in one period. Why? In order to position a company to generate sales revenue, but they may not be paid in the period incurred. Advertising bills may be paid several weeks later. Utilities may be paid typically within 10 days later after they're billed to the company. So the key is the advertising expense and the utility expense should be recorded in the period in which those services are performed or delivered, so that those recorded expenses then can be matched up against any sales recorded during that time period. To not record an advertising expense incurred in a time period or utility expense in a month that revenues were generated that used up that utility service would be to overstate income during that period. That is, you'd have revenues recorded because of sales, but if there's no expenses recorded that led up to those sales, there'd be an overstatement of net income because there'd be an understatement of expenses. So the time period assumption is primarily concerned about getting revenues and expenses properly matched in the right accounting period. We desire to recognize revenue in the period in which it is earned, not later if cash is expected to be paid later on that sale, and likewise expenses are matched with revenues in the period in which the company makes efforts to generate those sales revenues. This accrual basis accounting is GAAP. Accrual basis accounting defines the rules under which we record revenues when earned and expenses when incurred, not just when cash flows. So to review, which of the following statements about the accrual basis of accounting is false? The last one, D, revenue only being recorded when cash is received and when expenses when cash is paid. That is cash basis accounting, not accrual basis accounting. Cash basis accounting may be a lot easier to account for than accrual basis. However, it's not in compliance with the rules. It does not produce financial statements which are properly stated, but cash basis statements may actually be highly misleading, and therefore they are not GAAP. Now let's go back to the context of accounting, the accounting equation. As indicated, it contains all the elements of financial condition, that is, assets, liability positions, and owner equity or owner net worth positions. All financial statements are contained within the walls of this definition. The income statement is a subset of the equity section, revenue and expense accounts, part of owner's equity. The equity section, the ending balance of net worth, bringing in investments by the owner or divestments, is a balancing element of the balance sheet. So therefore, any income statement results of operations, revenue and expense measures also affect the balance sheet position. Now, when it's said that it mainly affects assets, ultimately cash is the bottom line in a business. It takes cash to start a business, and in the end, when it's dissolved, it's how much cash is left that goes to the owner. But in between, we have to deal with liability positions and accrual accounting, and so there's a lot more involved in the middle of a company's life than the beginning or the end of it. So we can affect balance sheet positions in both asset and liability positions with respect to the effect on the balance sheet when it comes to accrual basis accounting. Getting back to adjusting entries, what's the relationship? Because all reporting actions at a period end, be it quarter end or month end or year end, begins with an unadjusted trial balance. This is the effects of all transactions recorded on a daily basis throughout that time period. Reviews are needed to ensure the financial position is so reflected. Ending asset values, ending liability values are current and properly reflect those positions. That is, have revenue expense rules been followed. We need to adjust the trial balance through journal entries, balanced journal entries, debits equal credits, to ensure that our financial condition is up to date, fresh enough to produce financial reports that are in accordance with the rules of GAAP and fairly state the financial position of the company. So adjusting entries are necessary because the trial balance does not contain complete data. We have to ensure that the revenue recognition and expense recognition principles have been followed. This must be done every time a company prepares financial statements. If at the end of a particular month a financial statements, income statement, equity statement, balance sheet will not be pulled off, it's not critical that adjusting entries be prepared, but every time financial statements are going to be prepared, adjusting entries first must precede that. Every adjusting journal entry will include at least one income statement account, a revenue account or an expense account, and one balance sheet account, be it that an asset account or a liability account. As we've seen, the income statement and the balance sheet are interrelated. So looking at all the elements of financial condition, in terms of the income statement impact, we're concerned about expense accounts and revenue accounts. Are they properly stated? In terms of the impact on the balance sheet, are asset positions and liability positions stated? Again, assets are items that have future value. If that future value has been used up, the asset account must be adjusted. Likewise, liabilities are current debt obligations owed. If that is changed, that liability position must be changed. So the interplay between asset and liability accounts and expense and revenue accounts is the subject of adjusting journal entries. Expense and revenue because of the income statement, asset and liability because of the balance sheet position. Both statements are required to obtain fairly stated financial positions. Now, under what circumstances can an expense be recorded? Expenses be considered expired or consumed assets. So as assets decrease in value, expenses increase in value. That is, expenses reduce owner's equity, and so owner's equity is reduced when assets are consumed in the course of operating the business. Likewise, we can record an expense when it's been incurred prior to its payment. We would increase expense with a debit and increase a liability with a credit. Moving to revenues, when can they be recognized? When we incur a sale, when a company makes a sale activity on credit and the earnings process is complete, it should record the sale in that period before the cash flows. For example, accounts receivable will be increased with a debit, and a sales revenue account would be increased with a credit. It's called an accrued revenue. Another example of recording a revenue where cash is flowed beforehand. Let's say the customer has paid cash in advance of receiving their service. At that time, a liability is recorded. So at period end, accountants would review for the need to look at that liability position to see how much of that has been earned. Cash received in advance is not an earned revenue. It would have gone into a liability account. But when later service is performed, that liability account, such as unearned subscription revenue, would be decreased and regular earned subscription revenue would be increased. So again, the relationship between revenue and liability here is illustrated. This would be accomplished via a adjusting journal entry. Review question. Adjusting entries are made to ensure that all of the above. That expenses are recorded when they're incurred, not just when paid. That revenues are recorded in the period in which they are earned, not just when cash is received. And that balance sheet and income statement accounts have correct balances at the end of an accounting period. That is, they reflect current status. Overview comment. Staying in an overview mode here, looking at the forest before we get into the trees, any adjusting entry will increase either an expense account with a debit entry or increase a revenue account with a credit entry and have a corresponding offset change to either an asset account or a liability account in the balance sheet. As we noted earlier, the relationship between the income statement and the balance sheet is inseparable, because the reporting of the income statement is embedded in the owner's equity section of the balance sheet. And we previously stated that an expense can be recorded, it can be increased by either a liability increasing, it's an accrued expense, the expense is incurred, not yet paid, no cash has flowed, or cash may have previously flowed and we didn't record the expense, we recorded an asset itself, such as a prepaid, and so therefore we have to decrease that asset later and move that debit into the expense category as assets are consumed or expired. Likewise, revenues can increase by either an increase in an asset account, a credit sale is made, we increase accounts receivable with a debit, increase sales revenue with a credit, or we can recognize revenue increases by decreasing a liability account. Cash previously paid to us by a customer in advance of receiving services. When that occurred, we couldn't book it as a earned revenue, but as an unearned revenue. That's a liability. So later when the service is performed, such as Time Magazine delivering magazines for which you paid in advance, Time Magazine would decrease its unearned subscription revenue account with a debit and increase regular revenue with a credit, thereby recognizing revenue in the period in which they've delivered services, not just when they received cash in advance. These are all the combinations that can be embedded in our adjusting journal entries. There's two terms that accountants use in describing adjusting journal entries: accruals and deferrals. Let's pause for a moment to try to explain these terms. Accruals are events that anticipate cash movements in the future, such as revenues are recorded on an accrual basis because the sale event has occurred, but cash will be paid later according to terms of the sale. We call that recording an accrued revenue transaction. Likewise, we may incur expenses today that won't be paid for 30 days, so we don't wait for the cash to be paid out to record the expense. We accrue the expense today in the period in which benefits from that expense service. Deferrals, these refer to cash exchanges that occurred either in or out in the past from prior transactions that require updating. For example, we may have prepaid certain expenses. Prepaying insurance for a year period, we don't want to expense it all in the month it was paid, but we want to expense it in the time periods to which that insurance policy applies to. Likewise, some customers pay in advance. If you want a subscription to a magazine, you pay in advance. The magazine company will book that cash, but can't call that an earned revenue. In effect, establishes an unearned revenue account. So later, when it delivers it, it has to examine that unearned revenue to determine how much was earned, and therefore adjust the effects of the previously recorded liability, unearned revenues. The term deferral comes from the fact that when cash exchanged hands previously, either in or out, the ultimate destination in the accounting records for that transaction as concerns the cash has been delayed. The ultimate destiny, if you will, of a prepaid expense is to hit an expense account, reduce owner's equity. The ultimate destiny of being cash received in advance by a customer is to eventually record that as earned revenue. However, those conditions have been delayed because expenses haven't matched up in the period in which they apply to, or the cash received in advance has not been earned. And so therefore, separate but related transactions are required to adjust those positions, adjust an asset position, adjust a liability position to either release expenses in the income statement or revenues into the income statement. If use of the term deferral does not completely resonate with you, I'd rather you see it in action to understand the need for adjusting journal entries. But both of these categories affect the timing of revenue recognition or expense recognition. By recognition, I mean when it's recorded, when it's booked into the accounts. Again, deferrals, cash previously flowed either in or out, and the original offset account to that cash entry needs revising. That offset account, the original one, is not the final destiny of the transaction. Prepaid expenses are assets. They become expenses as the time periods expire or lapse that payment related to. Or liabilities become regular revenues. Cash paid in advance becomes recognized as earned revenue in the period in which services are later delivered to the customer. Accrual entries, again, they anticipate cash in the future. No cash has flowed yet, either in or out, but financial condition has changed. A credit sale results in an asset increase on the balance sheet, accounts receivable. The promise of customer to pay is an asset. Likewise, incur an expense today that will be paid next month. The expense should be recorded in the month in which it's incurred, in which you've received that service, not later when it's paid. So financial condition is affected in both of those conditions, and the entry is accrued before cash is paid or received. Now, the starting point at period end, a month end, we have a trial balance, an unadjusted trial balance. Any statement that indicates it's a trial balance is assumed to be unadjusted unless it says adjusted. So we have an unadjusted trial balance. We're going to look at certain accounts to analyze it if the account status is up to date. It's a little bit of a stretch to say each account is analyzed in the context of the adjusting journal entries we're looking at in this session. We're looking at certain asset accounts, certain liability accounts. For example, we look at the supply account, the prepaid insurance account, assets on our balance sheet at the end of a period, determine if they're still fully there. Have some supplies been consumed that we have to expense? Have some prepaid insurance periods lapsed or expired that we have to expense that insurance? These are events that are not looked at on a daily basis by companies, so at the end of a period they're looked at. Likewise, certain liability accounts, such as unearned service revenue, is examined to determine, has some of this been earned? We have to reclassify some of that out of unearned service revenue and into regular service revenue. The regular service revenue account at the bottom, $10,000, that account, whatever balance is in it after we're done here, will appear in the income statement. The unearned service revenue account, currently $1,200 as we're looking at it here, appears in our balance sheet as a liability. These are the exact conditions we're examining in this chapter to adjust to get our financial conditions stated properly. Remember that our definition of assets are items of future value, future economic value to a business to produce future sales. When an asset no longer has future value, when it's been consumed, it must be reduced, and we reduce the owner's equity category through expense accounts. So when it comes to expenses, that's precisely what we're doing in adjusting our accounts. We're looking at certain asset positions that have been expired, must be expenses, or we're looking at certain expenses that we may have incurred that have not yet been recorded. Increased expense with a debit, increase a new liability account, indicating that we have a present obligation that will be paid later. Prime example, as we'll see later, is the receipt of a utility bill. The utility measures our use of electricity or whatever during the month, gives us the bill at month end, gives us 10 days to pay it. We'll record that in the period in which we incurred the expense, receive the services, and not wait until we pay them the next month. Now, I'm going to briefly jump ahead to the final product. After we've done adjusting journal entries, we'll come up with an adjusted trial balance, which will have a different look, a different position of financial condition. Let's briefly look at the end product after we're done with all the work in this chapter. So from an unadjusted trial balance, end of a period, a month or a quarter, or even a year, we have certain financial conditions which must be refreshed. This next slide shows us that refreshed condition. We can see all the accounts in red have been adjusted during our period end closing process in effect. All the figures in red have been adjusted during our period end adjustment period. Accounts receivable has changed. We've increased it $200. It didn't exist previously. Supplies have gone down from $1,200 to $1,000. Prepaid insurance has gone down. Let me briefly look back at the starting point. We can see prepaid insurance was at $600. After adjustment, it's down to $550. Some period of time has been used up or lapsed in that policy, and therefore the asset has been consumed, and we reflect it as an expense at the bottom. As the $600 went down to $550, we increased insurance expense at the bottom by $50. That $50 of insurance expense will appear in the income statement. The remaining $550 of prepaid insurance up above stays on our balance sheet at period end. To look at another example, supplies. Let's look back at the starting point, $2,500. We take an inventory and determine that only $1,000 are left, so the remainder, $1,500, has been consumed or used up during the time period, and so we reduce the supply asset from $2,500 down to $1,000 by entry of $1,500 and recognize that as consumed items in supply expense. Supply expense appears in the income statement because those amounts have been used up during that time period. The last example to look at this point, interest expense. We've got a loan outstanding here from the bank, $5,000 note payable on our balance sheet. It's a liability account. During the time period, we've have not paid that back. We also have not paid the interest, the cost of the loan, but we recognize its expense during the month. In this case here, we have a $50 interest payable amount that's been accrued. We accrue that expense at the bottom, interest expense, debit $50, interest payable, credit $50. There's an example of an adjusting journal entry, which we'll look at more closely in the coming pages, but you can see how financial condition has been changed from our original starting position to our ending October 31st position, where we have an adjusted trial balance showing the effects of our adjusting entries after we recorded them and posted them into the ledger. The overall number of debits and credits have increased. What was it previously? $28,700 total debits, total credits. When the dust settles, we have $30,190 of debits and credits in our adjusted trial balance. And at this point, we can pull off financial statements not in the previous starting point. Okay, let's start getting down to the trees, the individual transactions illustrating adjusting journal entries. Let's start with accruals. Again, what are accruals? They anticipate cash in the future, either in or out. So we're going to record an event before the cash has flowed, either in or out. In for a credit sale or out for an incurred expense to be paid later. So we'll either record revenues earned or expenses incurred before the cash has flowed. We're just reviewing for these type of events that may not have been recorded previously through daily entries. Taking accrued revenues as the first example, again, these are revenues earned before the cash has been received. We provided service to a customer before they paid us. This is a sale on credit. We're giving our customers time to pay it later, 30 days or so, but we're going to record the revenue event before we ask for cash payment from our customer. So let's take the example of performing services such as advertising in advance. Let's say we're a newspaper. We'll run ads for a customer. They can pay us 30 days later. So the sale is a credit sale. We're going to increase our receivable, showing that our customer is going to owe us something. It's a present obligation they owe us, a present receivable from our books. So we're going to record that first. So we're going to record that when the credit sale is made. We're going to increase an asset account with a debit and increase a revenue account with a credit. In effect, this is a recognition that an asset has been obtained, the promise of our customer. Why did that asset go up? Because we made a sales revenue activity. Prime example of accrual basis accounting. Book the event, book the accrual in the period in which it is earned, not necessarily when it's paid. Recall the asset accounts on the left-hand side of our equation. The revenue account is under owner's equity on the right-hand side. Everything on the right-hand side of the equation are reasons that explain why assets have changed on the left-hand side of our equation. So we're Pioneer Advertising Agency. We provided advertising services for our customer in the amount of $200. We have not received cash yet. We give them 30 days to pay for it. And furthermore, we review at month end to ensure that we've recorded all such events, and we found one that has not been recorded. So as of period end, October 31st, we need to ensure our financial condition is properly stated. So we're going to make an accrual entry at period end to reflect the fact that we have a promise from our customer to pay later. Record accounts receivable, debit $200. It's a current asset. Why do we have an asset? Because we have a sales revenue event. Credit service revenue, $200. Now, the example doesn't indicate when this credit sale occurred. It could have occurred during the month of October, and we simply overlooked recording it or billing the customers. This is one of the reasons why we review situations, circumstances at month end, period end, to ensure that we've properly stated our financial condition before we pull off financial reports. And here, let's say we discovered that we have an unbilled service. Let's record that service as a month end and send out the bill to the customer. In this case here, whenever the sale was made, we told our customer, you have until November 10th the next month to pay us. That's a separate but related transaction. Our focus here is the October 31st accrual entry, not the fact that on November 10th we're going to get paid. That entry would look like we received cash on November 10th the next month, $200, and we reduced our accounts receivable $200. That's just an exchange of assets. Assets have not increased in total on the November 10th cash transaction. They've just rearranged themselves. On the 10th, we're just collecting cash. We're not reflecting the sale activity. That was back up in October when we provided advertising services to our customer. That's when our total assets increased on the left-hand side of the equation. And we explain that with the service revenue entry on the right-hand side at that time. We're going to reflect in October the fact that we made a sale, not in November when we collected it. Again, separate but related transactions. Looking at the detail of this transaction, we analyzed that, again, at the end of October, that receivables have increased, the promise of our customer to pay us, so therefore we're going to increase accounts receivable by $200, left-hand side of the equation, and the offset is an increase to owner's equity, service revenue account, plus $200. Formal journal entry, debit receivables, $200, credit service revenue at the end of October to record this accrued revenue. The bottom indicates simply the posting of that journal entry into the ledger as of October 31st. So, recapping our need for accrued revenues, the reason being revenues have been earned but not yet received in cash or previously recorded, so therefore we're going to make an adjusting journal entry at month end. If we do not make that entry, or prior to making it, our assets have been understated, receivables have been understated, and our revenues have been understated that appear in the income statement. So the adjusting journal entry, debit assets or increase them, specifically the account receivable account, and credit revenues, in this case sales revenues, earned sales revenues, that will appear in our income statement. The note at the bottom indicates an example of a company recording sales prematurely, not in the period in which they were earned. That is, to bolster their results of operations, they backdated the sales event so that sales in that period would look better prior to them actually occurring or earning them. That would be an ethical violation and an example of a misleading financial statement. Earned sales revenue should be recorded in the period in which it's earned, and not previously or not later. Moving to accrued expenses. Again, accruals meaning events that anticipate cash flowing in the future. We're going to record an expense before cash payment is due. This is a common business experience where we'll record or book expenses before they become due for payment. So an accrued expense would record the obligation, the liability, and recognize the expense in the period in which it's incurred. The adjusting entry consists of increasing an expense account, debiting it, and increasing or crediting a liability account. Expense indicates that we received some benefit or service in the current period in order to generate sales in that period, but we haven't paid for it yet. So we're going to reflect that expense with a debit, and the offsetting entry is to reflect the increase to a liability account on the right-hand side of the equation as indicated. Again, accruals anticipate cash flowing later. The example we have here is incurring salary expense before we pay it. Now, to cut through some of the detail here, which is pretty busy at the bottom, the upshot is that the company makes payments of its salary every 2 weeks. However, at month end, October 31st, we need to pull off financial statements, and so we want to reflect financial condition before payment of the next payroll on November 9th, the cash transaction date. So what's occurred here is we've received the benefit of our salary, of our employees' services for the last week in October, the 29th, 30th, and 31st of October, before we're going to pay them on November 9th. So we need to reflect the salary expense for those 3 days in October prior to paying them in the next month. So the analysis is that we've determined that it's $1,200 that pertains to those 3 days that have not been paid but earned by our employees as of October 31st. So we're going to increase our salary and wage expense by $1,200, which has the effect of reducing owner's equity, and we're going to record a liability to our employees of $1,200. Formal journal entry: debit salary and wages expense, $1,200. Credit salary and wages payable, $1,200. The bottom shows the posting of this journal entry into the ledger. Increasing wages expense by $1,200 with a debit, increasing salary and wages payable with a $1,200 credit as of month end. Adjusting entries are focusing on the activity not yet recorded for a particular time period. As we can see that we've had previous salary and wages recorded in the month of $4,000. It's the $1,200 at month end, that last 3 days that have been earned but not yet recorded, because payment won't occur until the next month. So the adjusting journal entry reflects this change in financial condition, this accrued expense for those 3 days only. Another accrued example, the 3-month note that our company has incurred. We borrowed the money on October 1st. It appears, according to the terms, that it's a 3-month note and we'll pay back the principal amount and all interest at the time of maturity. However, along the way, the cost of that loan must be recognized in the periods in which benefit from it. So during the month of October, we're going to record 1 month of interest expense that we're not going to pay until later. So the face amount of the note, $5,000, 12% annual percentage rate, and multiply that times 1/12. So $50 is the interest expense that's applicable to the month of October. So the entry is to debit interest expense, $50. That'll appear in the income statement as a reduction of our income for the month, and credit interest payable, increasing a liability position. We'll pay that off when the note matures 3 months later. Now, all notes payable might require, or some notes payable might require the payment of interest on a monthly basis. Here's an example of the bank saying, no, pay me everything that you owe me, principal and interest, when it matures 3 months later. But as a function of time, we have to recognize the interest expense in the period in which it applies to. The full analysis of this accrued expense: we're recognizing an expense which has the effect of reducing owner's equity and increasing our liability because we haven't paid it yet. So the formal journal entry, debit interest expense, $50, credit interest payable, affecting an expense account and a liability account, with the corresponding posting to the ledger at the bottom. So recapping accrued expenses, the reason for the adjustment is that expenses have been incurred. We've received the benefit of some service, but it's not yet been paid. Before the adjustment, our expenses are understated because they have not been recorded, and our liabilities have been understated because we haven't recognized the fact that we owe that money later. Adjusting entry, debit expense, a specific expense. In the last example, it was interest expense, and crediting a liability, or in the last example, it was interest payable. The adjusting entry shown here is a generic entry. As you make them for purposes of homework, you declare specific expense accounts, specific liability accounts. Let's move now to the deferral type of adjusting journal entries. You recall we defined deferrals as a cash transaction has been recorded previously, and we're going to adjust the effects of that. We're going to put parts of the effects of that into our income statement that previously has been deferred. Prepaid expenses, we're paying expenses in advance, and we book that as an asset, and we have to adjust that asset position, moving some of that to an expense as that asset has been consumed. Likewise, unearned revenues, meaning that the previous cash transaction, using magazine as an example, the magazine has collected cash in advance before it starts delivering its magazines, so therefore that previous cash was recorded as an unearned revenue, a liability, and we have to adjust that as we deliver magazines and earn that revenue. So either an asset or a liability has to be adjusted, and the offset is going to be either an expense or a revenue account. Taking unearned revenues first, this means that cash has been received before the earned revenue has been recorded. So the cash received in advance has not been earned and therefore was booked as a liability. We're going to adjust the liability position and push credit dollars into an earned revenue account. The objective is to record that revenue that's earned and reduce the liability that we previously booked. So it results in a decrease to a liability account, which would be a debit entry, and an increase to a regular earned revenue account, or a credit entry. So unearned revenues on the left, the liability position is reduced through a debit, and earned revenue on the right is increased with a credit. So the example shown here is our company, Pioneer Advertising Agency, collects money in advance from a customer. They want to ensure they can get our services, so they're going to pay us in advance. That advance payment booked the cash, but booked an unearned service revenue account, a liability, when received. Now we're going to analyze that liability account, that unearned service revenue account, at month end to determine if we've delivered any services and have earned a portion of that. In this case here, the example is our analysis reveals that the company has earned $400 of those fees during the month of October. Therefore, the adjusting journal entry, reduce unearned service revenue with a debit, it's a liability account, and increase the regular service revenue account, $400. Again, the service revenue account credit at the bottom appears in our income statement for the month of October. The unearned service revenue account, the remaining balance, which in this case will be $800, stays in the balance sheet as a liability because we have not performed the balance of those activities. I want to stress here that the adjustment entry is for the change. The balances will take care of themselves after we post the entry. So we're focused on the change in financial condition. Knowing that in this example here that we still owe $800 worth of future services, we're not making an entry for that. That will come out after we post this entry into the ledger. So looking at the full analysis, the unearned service revenue account is decreased by $400. That decrease in liability is a debit entry. The owner's equity account service revenue is increased by $400 with a credit entry. Formal journal entry, debit unearned service revenue, credit service revenue, with the subsequent posting into the ledger. Now we see in the ledger at the bottom the fact that the unearned service revenue position has been reduced from $1,200 to $800. That's a liability, meaning that we received money in advance previously, but have not yet delivered on $800 worth of services. That will remain a liability position until we deliver on our services to our customer and make a later adjustment when we do deliver those services. So we've affected a balance sheet component on the left and an income component on the right. Every adjusting journal entry affects a balance sheet component and an income statement component. To recap accounting for unearned revenues, the reason for the adjustment, that liability account or portions of it may have been earned, so it has to be adjusted. Before the adjustment, the liabilities are overstated and earned revenues are understated. The adjusting journal entry, debit the liability position, the unearned revenue account, and credit a regular sales revenue account, the latter of which will appear in your income statement, the former of which, whatever balance is, remains in the balance sheet. Turn our attention to prepaid expenses. This is the last component of deferral journal entries. Again, deferral adjusting journal entries are affecting a condition that was previously recorded because cash flowed, and now we're adjusting that position. So the cash payment has recorded previously, and our focus is to determine, has any of that asset been expired, and therefore do we have to record an expense? Again, expenses are consumed or used up assets. This condition relates to the passage of time or through use that we have to make an adjusting journal entry. So at period end, we're going to increase an expense account with a debit and decrease a related asset account with a credit. Asset positions are going to be reduced on the left-hand side of our equation, and our owner equity position needs to be reduced likewise on the right-hand side, in this case through the use of an expense account. Credits to assets deflates that side of our equation. Debits to an owner's equity account deflates that side of the right-hand side of our accounting equation. Illustration here has our company, Pioneer Advertising, purchasing supplies early in the month. We're going to record them as assets because we haven't used them yet. At month end, we're going to take an inventory of our remaining supplies to determine how much by inventory difference has been consumed during that month. So it's going to look at two events, what we have on our balance sheet to begin with during October, $2,500 of supplies. Here we're not measuring our use of supplies on a daily basis. That could occur, but it's more likely not to occur because you'd have to spend too much time, so we just wait till month end. Anyway, to reset the stage here, we bought $2,500 of supplies early in the month. They're on the balance sheet as an asset because we're going to use them over several days or months. At month end, we're taking inventory and find that $1,000 of supplies are remaining still on hand, so the difference has been consumed. Our entry, debit supplies expense, $1,500 of the consumed supplies, and credit the supply asset account, $1,500. Reduction of assets, reduction of owner's equity through an expense account. The the full analysis of this transaction. Assets on the left, supply account is being reduced, and the owner's equity position is being reduced. Owners, in effect, fund all expenses. They get credit for the revenues, so they have to fund expenses. Formal journal entry. Debit supply expense, $1,500. Credit supply asset account, $1,500. With the subsequent posting to the ledger at the bottom. Again, we've affected a balance sheet account. The supply account shown at the bottom has been reduced from $2,500 down to a $1,000 balance through this adjusting journal entry. And supply expense, an income statement account, has been affected on the right-hand side by increasing expense or reducing owner's equity position by $1,500 through the debit entry. Another example of adjusting a prepaid expense entry. When we paid our insurance that began on October 1st for a full year's $600, we didn't expense it when we paid it because it's going to affect several months, 12 months worth. So at month end, we recognize that 1/12 of that amount has lapsed. We've received the benefits of that in effect. And so the adjusting journal entry is going to record an expense, insurance expense of $50, 1/12 of the $600, and reduce the asset account, prepaid insurance, by $50. Again, prepaid insurance is an asset because it affects future periods. It has a future economic benefit for us throughout the year. Detailed analysis of the transaction. Asset account is going to be reduced by $50, and our owner's equity position is going to be reduced by $50 through the use of an expense account. Formal journal entry, debit, insurance expense, $50. Credit, prepaid insurance, $50. Again, you see the impact on an asset account, a balance sheet account that is, and an income statement account, an expense account. Adjusting entries will always affect two components, one in the balance sheet, one in the income statement. Let's talk about depreciation. This is a special topic, and this chapter is your first exposure to it, and so let me expand on this. This could be considered an extreme example of a prepaid expense which requires adjustment at month end or any period that prior to pulling off financial statements. Depreciation is a process of allocating an original cost of an asset, a long life asset, over its useful life. So these expenditures are recorded as assets initially because they will be used over many years. The benefits will be obtained over many years, and so therefore we will simply systematically allocate that original cost over the life of use to obtain an expense during that period, as those assets are considered to be consumed. So reporting a portion of the cost of a long life asset as an expense, specifically depreciation expense, during each time period that the asset is used. As noted at the bottom, depreciation does not attempt to report the actual change in value of the asset. We're talking about fair values here. Companies don't look at an asset, a building, equipment, and say, what's it really worth at the end of the time period, and then make a depreciation entry. It's dealing with the original historical cost of that asset. This is current U.S. GAAP rules, which might parenthetically be adjusted in the future, but a depreciation expense entry simply is recognizing that some portion of the original cost of an asset has been diminished or consumed, and therefore we have to move that portion from the balance sheet, the asset, into the income statement as a depreciation expense entry. Again, the theme here, expenses are measures of consumed or used up assets. Assets used up in the pursuit of the profit-seeking activity, making sales. In the example here, we'll start off with the fact that depreciation expense for the whole year for a piece of equipment will be $480. We're dealing here just with 1 month. Here is our company came into existence during the month of October, and so 1/12 of that, or $40, we'll have to deal with in terms of an adjusting journal entry related to depreciation expense at month end. So we're going to debit depreciation expense, $40. Credit an account called accumulated depreciation, $40. Again, this is just a systematic allocation of the depreciation expense for the month of October. Note that the account accumulated depreciation is not the equipment account itself, but it's a new account. We're seeing it the first time in this chapter. It's called a contra asset account. What does that mean? It modifies or values the original equipment account on our balance sheet. Over time, we want to maintain the original cost of that in one account. We will accumulate our depreciation expense entries in a separate account that's related to that equipment account. Both of those accounts will appear on our balance sheet under assets. So we maintain our original cost of the equipment, whatever that is, and we will indicate the allocation of consumed portions of that by use of an accumulated depreciation account. So the upshot is that we're increasing expense affecting our income statement with the debit, and we're affecting our balance sheet with the credit to accumulated depreciation. This is a periodic adjusting journal entry. By contra asset, we mean that account, that accumulated depreciation, will appear under the asset side of our accounting equation in our balance sheet, but its normal balance is not a debit, but its normal balance is a credit, hence contra asset account. We learned earlier that the normal balance of asset accounts are debit. That remains intact and true. We have some accounts that normal balance is a credit balance. So together, we show the remaining value of the cost of the asset in our balance sheet. An analysis of the transaction. Assets will be reduced on the left, $40. Owner's equity will be reduced by $40 on the right-hand side. Again, this is an expense of doing business. Assets are consumed as they are used over time, and so therefore we're reflecting it as a reduction of owner's equity. Formal journal entry, debit depreciation expense, $40. Credit, accumulated depreciation, equipment, $40. You can see at the bottom as this entry is transferred or posted to the ledger that our original cost of equipment, $5,000 in our equipment account, remains unchanged, but it's going to be modified by our accumulated depreciation account equipment at the bottom. So the two accounts on the left are in our balance sheet. Depreciation expense is an owner equity account affecting our income statement. Let's spend a moment reviewing our balance sheet statement presentation of this new account. As indicated, it's a contra asset account. It appears right after the account. It offsets the equipment account on the balance sheet. The normal balance of contra asset accounts are credit. So therefore, on our balance sheet, we'll show equipment, $5,000, less accumulated depreciation, $40. The net of those two numbers, $49.60, it's called net book value. It's the remaining cost that will be depreciated over time. That is, we'll recognize depreciation expense over the remaining life of that asset. So a recap of accounting for prepaid expenses. The reason we're making adjustment entries in this area is because we have an asset recorded in our accounts that may have been used up or consumed, or a portion of it used up or consumed over time. Therefore, before we make the adjustment, our assets are overstated, our expenses are understated, and our adjusting entry to correct for that position is to debit an expense account. The last example was depreciation expense, and credit an asset account, or in our last example, crediting a contra asset account. Again, that adjusting entry shown here is a generic description of what's happening when we account for prepaid expenses. Reducing assets and reducing owner's equity through the use of expense accounts, both on opposite sides of our accounting equation. In summary here, let's look at all the relationships which we've affected in doing adjusting journal entries. The most recent one we discussed, prepaid expenses. Before adjustment, assets are overstated and expenses are understated. And so we adjust for that position by debiting expenses, reduces our owner's equity, that's our income statement effect, and reducing assets with a credit. Unearned revenues, money is received in advance. When that money was received, it's booked as a liability because it has not been earned, services have not been provided. And so the before adjustment, the liability position needs to be reduced because the regular revenues are also understated, and so we debit liability, reduce the liability account, and credit regular revenues. Again, affecting the income statement at the bottom and the balance sheet liability account in the first line. Accrued revenues, these are conditions where no cash has flowed yet, but we've made a credit sale, and so before making the adjustment, our assets are understated. For credit sales, it's accounts receivable that is understated, not yet recorded, and regular sales revenues have also not yet been recorded, and so they're understated until we make the adjusting journal entry. Debit assets, debit accounts receivable, credit revenues, credit sales revenues. Those are earned revenues. Just a digression, again, revenues are, the meaning is an increase in assets due to a sale-making activity. Sometimes that activity is not yet completed and we receive our cash in advance, so it's an unearned revenue. In the example here of accrued revenues, we've delivered the service before we've collected the money, so we increase assets and credit regular earned revenue. Accrued expenses, again, cash has not flowed out. Before we record this, our expenses are understated, our liabilities are also understated. The correcting, or the condition that's corrected by our adjusting journal entry, is to debit expense as the effect of lowering owner's equity, crediting a liability account, which is an impact on our balance sheet. So we're reflecting expenses before we paid for them by establishing a liability, a present obligation to be paid off later. After recording all our adjusting journal entries that are balanced in terms of debit dollars and credit dollars, they're posted or transferred to the ledger. The purpose of an adjusted trial balance to prove out the equality of our debit balances and credit balances after we've made these adjusting journal entries at the end of a period, and is the primary basis for the preparation of financial statements. That is, our financial condition has been reviewed and updated as necessary to allow us to pull off financial statements, income statement, equity statement, balance sheet that properly reflects our financial condition. After recording and posting all our adjusting journal entries, here we have an adjusted trial balance. Again, all the numbers in red here indicate adjusted positions. I'm just noticing that the publisher doesn't have the service revenue of $10,600 in red. That should be red, that was affected. And I want to comment on that number, how it changed from our original position At the start of this session, service revenue, earned service revenue on our trial balance, or unadjusted trial balance, was $10,000. Now it's at $10,600. What accounts for the change? Our adjusting journal entries. Number one, we booked $200 of unbilled sales, credit sales at month end that it previously had not been recorded. Our receivables went up by $200, and our sales revenue account went up by $200. That was the change. Secondly, we looked at some unearned service revenue, cash paid in advance by customers, and we earned $400 of that. So our unearned service revenue account went from $1,200 credit to $800 credit, and we transferred, in effect, $400 of that into our earned service revenue account. Therefore, that accounts for our change in service revenue, which will appear as an item on our income statement, from $10,000 to $10,600. Increase of $200 from a credit sale, not recorded previously, and a $400 transfer from unearned service revenue that we had received earlier but had not earned, but now through our adjustment, we've reflected that we've delivered those services, and therefore we increase our regular revenue account by $400, resulting in a final balance of $10,600, which we'll start our financial statement preparation stage with. Here's a review question before we look at our financial statements. Which of the following statements is incorrect with respect to the adjusted trial balance? First of all, it does prove the equality of debits and credits after all adjustments are made, so A is a correct statement. B, it provides the primary basis for the preparation of financial statements. That's a correct statement. Now, let me look at the last one. D is prepared after the adjusting journal entries have been journalized and posted. That's correct. That leaves C, which is incorrect. The adjusted trial balance lists the account balances segregated by assets and liabilities. They're not totally segregated, they're just listing accounts. The segregation is by debit and credit, not by all the asset accounts being together and all liability accounts being together. Prime example is our accumulated depreciation account for equipment. That's under the credit column, but it is an asset account. So to restate, our adjusted trial balance now allows us to pull off our income statements, owner equity statement, and balance sheet because the financial condition has been updated, refreshed, it's stated correctly, and now we can pull off financial statements. Recall from previous sessions that our income statement is one that expresses activity over time. Our owner equity statement, activity over time, but our balance sheet is a snapshot of any balances at the end of a period. This shows the development of our financial statements from our adjusted trial balance. Recall my statement earlier that all our financial reports are contained within our accounting equation. The adjusted trial balance reflects all accounts in our business, and financial statements is simply peeling off certain accounts for certain purposes. So for income statement first on the right, we simply segregate all our earned revenue accounts and all our expenses and put them on a separate piece of paper and call it an income statement. And total earned service revenues of $10,600 less all the expenses totaling $7,740. The excess of revenue over expenses is $2,860. That's our net income for the period ending for the month of March of 2012. Now I want to point out something here. The income statement is simply a report. It's a report of the R&E accounts, the revenue and expense accounts of the business over a period of time. The income statement is not a journal entry. The two columns indicated here are not debit and credit journal entry, even though it happens that our revenues are on the right-hand side and our expenses are listed on the left-hand side. It's not a journal entry. It's simply a report. The columns are used to highlight pieces of information. We want to highlight the net result way off to the right, and so therefore we push our one service revenue account out there right away. We simply indent and list all our various expense accounts and subtotal them to 7740, bring it out to the right. We want to focus on our total revenues and total expenses to get down to a net income of 2860. The report itself is not a journal entry. It's simply a report of certain measurement accounts contained within our trial balance, our adjusted trial balance. Secondly, our owner's equity statement at the bottom. Now, this was an example of our company, Pioneer Advertising Agency, starting in the month of October. So when it started out, the owner had nothing in his owner's capital account. By looking at the adjusted trial balance and knowing it's the first month of operation, we are concluding that the $10,000 was an investment by the owner. If there's any doubt about that, we go back to the journal entry to see that it was an investment by the owner, where he put in cash, the owner put in cash, and credit was given to his owner's capital account. So the equity statement, very condensed. Investments by the owner, $10,000 during the period. It inherits a net income number in one single number from the income statement. Subtotal, $12,860, and deducts out any owner drawings during the period. Looking back at our balance sheet, we see our owner's drawing account, $500 debit. That's a deduct in our owner's equity statement, down to a bottom ending owner's capital of $12,360. We'll be looking at this development of financial statements from adjusted trial balances in the next chapter as well. I'm just pointing out here that the adjusted trial balance is the starting point of the actual preparation of financial statements. These diagrams also show the interrelated nature of financial reports. All other accounts forming the balance sheet, all our asset accounts, ending balances, all our liability accounts, individual ending balances. All our asset accounts total $21,910, and I want to point out the fact that we needed the contra account accumulated depreciation to deduct from our office equipment account to come down to a net book value of $49.60 of our office equipment after we made our depreciation expense adjusting journal entry. That combined with our other asset accounts, cash, accounts receivable, supplies, remaining supplies on hand to be used in future periods, prepaid insurance, the remaining balance of our insurance that we prepaid that'll affect future periods, with a total asset amount as indicated. Individual liability accounts totaling $9,550, and what do we need to balance our balance sheet? The ending owner's capital position as calculated in the previous owner's equity statement. $12,360, that's what's needed to balance our balance sheet so that our total assets equals our total liability position and our ending owner's equity position. By convention, balance sheets generally show assets on the top, liability and owner equity claim positions on the bottom. Wealth, $21,910, and which parties have a claim on that wealth. Creditors to whom we legally owe money, $9,550, and the owner's residual net worth in the business, $12,360.